Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring. How are you all doing? I appreciate you coming to my weekend review podcast. The format for this podcast, first of all, we're going to run the U.S. legal disclaimer. Secondly, we are going to go and take a look at all the trades that I made last week, both on the daily and the weekly time frames. We are going to talk about when I entered the trade, exactly why I entered the trade, what the setup was, what my strategy is, and then we're going to see how those worked, either to the downside or to the upside. Just in general, if I place a trade and it goes against me, then I'm usually right out of the trade for a loss, but very quickly. I say this every weekend, but it's very important that you are very impatient with your losing trades and get out quickly, and that you're very patient with your winners, and that you have a process to keep you in the trade. And you'll see the trades that I have been in for a while there, I've obviously been in them for a while because they are positive trades. But if they're negative trades, I am out very quickly. I can always re-enter if I get another move to the upside, or I get another signal to the upside. So, it's human nature to want to think things are going to be okay. So if you get into a trade and it goes down, you can think, well, maybe I'm not going to get out here. I think it'll go back up, right? I think that all the time. But I've been trading for 28 years, and I realize that when your signal has become untriggered, or it closes below the level of why you entered the trade in the first place, it's just good to go ahead and get out. Take that small loss. The small loss is the easiest loss. Yeah, it stings. It's never fun, but when you get out and things keep going down, you're like, oh my gosh, thank goodness that I got out of this trade. And I will show you, I had a trade on gold that I took a loss on, but my gosh, if I would have held it, it would have been horrible. So if I can try to um, give you all some good practical trading advice, it is to be very impatient with your losers, get out quickly. You can always re-enter if you get a new signal, and be very patient with your winners. Have a process that will keep you in the trade. Doesn't mean that, well, as you know, if you've been listening to this podcast, I do take partial profits all the time. It helps fulfill that need to do a little something, and it is important to take partial profits when the market gives you something, but to keep that core position for a much larger win, because in trading you're going to have many losses, but you need some big wins to cover those losses, and to, at the end of the day, give you a net profit of trading for the year after a year, right? So you have large wins, obviously, okay, preferred, right? Small wins, totally fine. Scratch trades, which means break even trades, also totally fine. And small losses, of course, that's completely fine as well. But what you do have to stay away from in trading are the large losses. And if you are patient and you wait for a good setup with a good risk to reward ratio, with a confluence of signals, now you have a structure for the trade. And if that trade immediately fails, boom, well, you're out because your structure told you. The problem is when you get into a trade and you hold it and it goes against you and you do not respect your stop loss, then what do? You're just hoping, right? A lot of hopium. So my suggestion is wait, be patient, wait for a good setup, wait for the structure that you want, where you know exactly where your loss is, and just go ahead, pull the trigger, and get out of your loss. So anyway, sorry, that's a bit of a rant, but in this particular market, which has been quite bearish over the last few weeks, following that advice would have been good advice. All right. So first of all, U.S. legal disclaimer. Secondly, we're going to go through all my trades, see how they worked out, when I entered them, why I entered them, how I'm going to manage the trade going forward. After that, we are going to do a little bit on trader psychology. Trader psychology is the most important skill in trading, everyone. It is the most important skill, and it is a skill. the skill of having a good trading plan based upon good trading principles and then following that plan. No one really thinks about that as a skill, but it's the most important skill. So I always like to talk about it. It's helpful for me to talk about it and teach it, and I hope it's helpful for you as well, because at the end of the day, that really is the most important skill. Being able to create a trading plan based on good trading principles and then following the plan. If you don't follow the plan, what good was the plan in the first place, right? After that, I have gone down through my watch list, both my master watch list, both on the daily and the weekly time frames, and I have identified some potential trades that I am looking for next week. Now, these particular markets are not going to be where they need to be, because I probably would have taken them if that was the case, right? They need to go higher or lower in order to create a structure that that I prefer, that has a confluence combination of signals and a good risk to reward ratio and a very defined line in the sand. What I mean by line in the sand, it just means a level that, hey, if it stays above that level, I'm good, I'm in. If it closes below that level, I am just out. So, you know, the market with this pullback has given us some good opportunities. A month ago, a month and a half ago, I had barely anything to talk about because we were so high. And the way that I trade, I'm not going to buy things up there. And luckily, I didn't. But there are some interesting propositions going on right now. There really, really are. All right, sorry, I got a phone call that I had to take. It was from my buddy overseas. Now I kind of forgot where I was. Okay, we're going to go down through the daily and the weekly charts, and I've identified some potential entries that I'm looking for. Of course, when I'm looking for an entry, what I'm looking for is if I'm to the long side, for an example, a deep dip buy, I'm looking for some kind of rejection, 200-day moving average, 250, 300, possibly an under 30, over 30 for a deep dip buy. And as always, what I'm looking for is a combination confluences of indicators lining up. If I have an under 30 over 30, okay, it's decent. But if I have another one that has an under 30 over 30 and under 200 over 200 SMA, well, then that becomes better. Then you throw in a V1 or a V2 entry. That also adds bonus points to the trade. I also look at the larger time frames to see whether or not we're finding some kind of support at some kind of level on the higher time frame, usually a factor of 5. So if I'm trading the dailies, I want to look to the weeklies to see if I have some combinations and confluences of rejections on both time frames happening. So I have identified a handful both on the daily and the weekly. We'll go through, we'll look at the multiple time frames, and I will tell you what I am looking for next week for a potential trade. All right, and just so you know, I do offer a private one-on-one stock trading course in the evening time via Skype. It's a 15-hour course. It is a great course. I teach you all 5 of the different trading approaches that I use. I teach you step by step so that when you are done with this course, you will really know how to trade. Everything that I do, I will teach you, looking for good risk to reward ratios, combination, confluences of signals, how to identify that this trade is better than that trade. And I think the best way to learn anything, whether it's baseball or guitar or trading, is one-on-one with a teacher or a coach that has experience. And I have a lot of experience. I've taught people from all over the world, from absolute beginners to top hedge fund managers as well. So if you're interested, the course does cost $1,750, but it is an investment in yourself to learn a skill that you can learn for the rest, or that you can use for the rest of your life. So my email is in the link in the description. Just reach out to me. We can start a dialogue, and if it sounds good to you, we'll do the lessons, and you're going to learn a lot. So, all right, before we get started, let's run the U.S. legal disclaimer, and then we will get rolling.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get rolling. This is SPY. These are the daily trades that I took on SPY. I did get long SPY on the 26th of September. Why did I get long? Well, it was a deep dip buy approach where during the day we went under the 30 RSI. The 30 RSI is a key level. It went below the 30 during the day, bounced off the -5 Keltner channel, and then closed above the 30 RSI. So that was a rejection of the 30 RSI level. So when that happens, when I have my signal, the first thing I have to do is I have to properly position size. It's all based upon the total value of your account. I like to use 1% of an account for my maximum allowed loss. So, excuse me, for these purposes, let's just say we are using a hypothetical $100,000 trading account. $100,000 times 1% is $1,000. Now, I take the $1,000, I divide it by the value of the 2 ATR. Right now, the value of the 2 ATR is 896. Divided by 896, it would tell me to buy 111.6 shares. I would just round that up to 112 shares. Now, if the market volatility is high, you can see it's moving very strong. So the average true range is going to be larger. Dividing that into your maximum allowed loss is going to give you a smaller amount of shares to buy. And that's correct. That's what we want to do, because the volatility is high. It means it's moving a lot. Therefore, we would want to buy fewer shares. If the volatility was low, the ATR number would be smaller, and therefore we would have more shares to buy. So the first thing you need to do is, when you see your trigger, you see a level, in this case the 30 RSI being rejected, and you go, okay, that's my trade. Then I'm going to position size. If you have a $1 million trading account, well, $1 million times 1% is 10,000 divided by 896. You'd buy 1,116 shares. So you see your signal, you look for the rejection of the level, you position size, and now you have two stops. First stop is your emergency stop. Your emergency stop is going to be exactly whatever the ATR value was when you did the math, in this case 896. So I would take my entry, I would minus $8.96 from that entry. That is my emergency stop. So if I have 1,116 shares and it moves down 8.96 down to my emergency stop, well, then I've lost that 1%. I've lost that $10,000, or I've lost that $1,000 if you have a $100,000 trading account. Now, this is not going to happen very often, but it's nice to know if you are wrong exactly how much you are going to lose. And so that's why I always have the emergency stop. But 95% of the time, we are not going to hit that. My loss will be my end of day stop. My end of day stop is, why did I take the trade? I took the trade because it went under 30 over 30. Therefore, the next day, if it closes back under 30, then it lost the level that was important to me, and I'm just going to go ahead and get out of the trade. And you can see the next day it opened up, but then it came down during the day. It wasn't looking good. It was way under the 30 RSI, but I always wait for the end of the day price, unless it hits my emergency stop. Then I get out immediately. But for my end of day stop, I wait for the end of the day, because the end of the day is the most important price. That's the closing price is the most important price. And in my opinion, that is because the large institutional traders, they take control of the market during the end of the day, and they move it to the most valid price. Well, you can see on the day that I took the trade, you can see 30.06 was the closing. Pretty good risk to reward ratio. If it just simply closes below 30 the next day, I'm going to get out for a loss, and hopefully a small loss. The next day, during the day, it was, the next day it went way below the 30, but you see how we closed back at 30.37. That kept me in the trade, and good thing that it did, because it moved up. Now, I always take a partial profit if it moves up the value of 0.45 ATRs from the previous day's close. 10% of the position size that I have remaining. The next day, it did go up nicely. I took a little off. That helped reduce the overall risk of my trade because now I've taken a portion of my position off, locked it in. Market can't take it back away from me. And then the next day, we opened way up here again, 0.45 ATRs from the close. I hit another profit target. So it's moving up. I'm reducing my position size, locking in profits that the market cannot take away from me. And it's a very important part of my trading. You have to play offense and defense. The defensive part is, well, first of all, looking for your entry. Then position sizing, that is defensive based upon the volatility. Placing your emergency stop, your end of day stop, this is also defensive. But taking partial profits when the market gives them to you to the upside, that's offensive. Just like any great sports team, you have to play offense and defense, all right? Now, you see this orange line here. What is that? That is exactly 1.5 ATRs from my entry. If we move to 1.5 ATRs for my entry, now I go into trailing stop mode, which is also a defensive move. So we didn't quite get there, but if I do get there, then I go into trailing stop mode, which means if I have a close below a previous bar's low, I will get out of half of the remaining position. If it just keeps moving up, great. Then I'll just continue to take partial profits. Once we get into the 65 RSI level, oh, actually, this is an under 30, over 30. So the next level above me that will be of interest to me will be the 50 RSI. If we reject 50 RSI, I will get out of half. If we reject the 50 SMA, I'll get out of half. If I have a close below previous bar's low, I'll get out of half. And if two of those three scenarios happen, then I'm completely out of the trade. But this only has to do with under 30, over 30 entries. Under 30, over 30 entries are a little bit more volatile. And so, therefore, I have different rules with an under 30, over 30 than I would, for example, a rejection of the 200-day moving average. I know it sounds complicated. It's really not once you're taught. And, of course, this is what I teach my students in my one-on-one. So, anyway, bought this with an under 30, over 30. The next day it went below 30, but closed above 30, kept me in the trade. Next day moved up, took some partial profits. Next day, Friday, moved up, took some more partial profits. Key level that I'm looking for now on this trade, of course, is if we get to trailing stop mode, then I go into trailing stop level, then I go into trailing stop mode. If we go down, if it closes under 30, of course, I'm just going to get out of the trade. So far, this has been a good, decent little trade with some nice profit targets, as you can see, much higher, up 0.36% on the trade. Qs. I did enter the Qs. Now, this is a better signal because it has more confluences. Let me take you back real quick to SPY. Okay, SPY's worked out so far, but all it was an under 30, over 30. That was it. Well, it rejected the negative fifth ATR channel, so it gets a few points for that. But all in all, the main signal was just the under 30, over 30. Now, if we go to Qs, this is a much better trade. Why? Well, because it had multiple confluences. It had multiple events happen that helped with the integrity of the trade. I took this here on the 27th of November. Why? Well, during the day it went under 30, back over 30, but it also created a V2. Here's bar 1, here's bar V1, excuse me, bar 1, bar 2. Bar 2 went under bar 1's low and then closed above bar 1's close. That's a good signal. And by the way, if you'd like to learn more about V1s, V2s, I have a video in my YouTube's playlist called V1s, V2s. A lot of people have watched that. It's a big part of my trading. It's totally free. So go and check that out. I think I also have a link in the description of this video here. But more confluences, under 30 during the day, over 30, plus a V1. So I position size, as I mentioned before. I placed my emergency stop 2 ATRs below. I placed my 1.5 ATR trailing stop above. Of course, if it moves up, I take profits. So the next day moved up, took some profits off the table, reduced the position size. Next day, Friday, moved up again, took some more profits off as well, right? And I'm also at trailing stop mode because we got to the orange line, which is 1.5 ATRs above. So now, going forward, if I have a close below a previous bar's low, I will get out of half. That's a defensive move. If it just continues to move up, I'll continue to take partial profits. This is an under 30 over 30, so the 50 RSI level will be a key level for me to watch to see if it's rejected. The 50 SMA as well, and then also close below the previous bar's low. So I know it sounds like a lot of rules, but every single rule that I use is for a reason, and that's why I use them. So anyway, so far so good on the Q trade, up an even 1%. AMD, now this has been a really nice trade, and this had even more confluences, and this one did even better. Okay, I bought this back here on the 25th of August. Why? Well, on that day, we went under the 200-day moving average and closed back above. Just that alone is valid. Okay, so I position, there's my entry. I position size. I place my emergency stop how far below? 2 ATRs below. I place my trailing stop level how far above? 1.5 above. But in addition to the rejection of the 200-day moving average, we also had a V1. Bar 1, bar 2. Went below bar 1's low, closed above bar 1's close. There is a V1. Excuse me. So rejection, intraday rejection of the 200-day moving average and a V1. My end-of-day stop on this, well, what was the main reason I took the trade? Was rejection of the 200-day moving average. Therefore, if it then closed below the 200-day moving average, I would get out. Close is the key word. So I got in here at 96.50. Next day, went positive for a minute, but gave it up, but held the 200-day moving average. You can see during the day it went below, but there were no more sellers down there. Closed back above. And when I saw that, I was pretty sure that this trade was going to work out. And also, another key thing that I teach in my lessons is about the halfway of the V1. Well, this was a V1. See the low here? See the high here? When you have a V1 like this, it should come back down and respect about halfway from the low to the high. It's exactly what it did. Isn't that interesting? How that's exactly right there is where it found support. So it tested the 200-day again. It held the halfway. I was like, this is looking good. So I placed my 1.5 ATR trailing stop level above. Next day, moved up nicely. Took some nice profits off the table. Thursday had a huge day up. Took, I think, 2 profit targets, maybe even 3 profit targets. And we also got to trailing stop level. So now, if I have in the future, if I have a close below a previous bar's low, I'm going to get out of half. If it continues to move up, I will continue to take partial profits. This is an under 200, over 200, so there's different rules. So now it's up nicely. I have a lot of breathing room. I've taken off partial profits, a good place to be mentally and psychologically with this trade. So I can give it some breathing room because I've taken the partial profits. So if it continues to move up, I'll take partial profits. Next level above me that's of interest would be the 65 RSI level. If it gets there, then if I have a close below the 5 EM, I'm going to get out. If we get up to the 70 RSI level, reject that, I would get out of half. After getting out of half with the rejection of the 70 RSI level, if I have a close below previous bar's low, then I will be out of the trade. If it goes my way. If it goes against me, and Monday we have a close below this previous bar's low, I will get out of half, continue to take partial profits. If it comes all the way back down, closes under 200, actually have to get out of that as well. But taking off half of the profits up here with the rejection or with a close below previous bar's low will very much help to mitigate this. So very likely this trade will be profitable no matter what happens. This trade is up nicely. Current shares that I have remaining up 6.15%. So nice trade on AMD. And then Walmart. Oh, this one got me. I did buy this on Thursday with this return to value V2, which, by the way, if you take a return to value V1 or V2, about 75% of the time, you're going to have a profitable trade. 25% you will not. and this was one of those cases. Return to value means here's the green line, here's the green line. Anywhere in here is the value zone. Now, Walmart's been very strong and resilient compared to the rest of the market, but this one did not work out. So we're above the value zone. We come into the value zone. We have lots of sideways motion, which is what I was looking for. And then we had a V2, bar 1, bar 2, bar 3. Bar 2 went below, bar 1's low, but then bar 3 closed above bar 1's close. That got me in the trade. Now, I position size. I placed my emergency stop 2 ATRs below, and my end of day stop on a V1 or a V2 is just a close below halfway. But we had some news on Friday that was not good for Walmart, and what happened. So I got in here at 162.62, and look, I hit my emergency stop. So I did not wait until the end of the day. As soon as it got there, which really means that it moved from my entry, the value of 3.59 cents below my entry. That's it. I get out. No questions asked. That was my maximum allowed loss that I was willing to take on the trade, and I just had to go ahead and take it for a loss of 2.1%. Okay, gold. Now, this was a losing trade. I did buy this back on the 22nd of November when we had a close under the 200 and over the 200. So I position size. I placed my emergency stop 2 ATRs below. My end of day stop is simply a close below the 200. That happened the very next day. Not fun. It was a losing trade. I got out for a loss of 0.46%, so not too bad. But look what would have happened if I had not taken that signal, everyone. If you, could you imagine going, I'll give it another day. I think it's going to go up. Next day goes down. Oh, I think I'll give it another day. I think it's going to go down. Down, down, down. Now you're screwed. Now this is a long-term trade if you don't get out, right? But do you see how important it is to get out when your signals tell you, yes, this is a losing trade, no doubt about it. But the discipline of getting out when I was supposed to saved me a lot of money. Saving a lot of money is like earning a lot of money, right? So this is a very good example here of why it's so important to take your loss, and a loss of 0.46% compared to if I would have held on 4%, factor 10. Then Etsy. I did get into Etsy back on the 21st of September with an under 30 over 30. Got in here at 63 or 64.30. Position size next day went up. Luckily, took some profits off, right? Helped mitigate the loss on the trade. Held the 30 RSI, but then here on the 26th, on that big down day, I had to get out for a loss of 3.52%. And then it rallied on me. But that's how it goes, right? So real quick recap, open position SPY up 0.36%, Q's open position up 1%, AMD open position up 6.15%, and then the closed trades last week, Walmart down 2.1%, gold down 0.46%, and Etsy down 3.52%. So not the best week ever, but actually traded it pretty well and held in there based upon the really tough market that we had last week. Let's go to the weeklies. Current weekly trades that I have are Alibaba. I did enter Friday at 86.40. I discussed this last week. I said there was a perfect return to value on the weeklies. We closed above, we came in, we moved sideways, we washed out the previous low, we created a V1. I didn't buy it. I actually missed this trade. But then after I saw this, I said I missed it. I was like, look, and I mentioned this in the podcast last week, here's the V1. Halfway of this bar, it should hold. If it does, it gives me a better risk to reward ratio than if I'd have taken it last week. And that's exactly what happened. So I did get long here, 86.40. I have my 2 ATR stop below me. I have my 1.5 ATR stop or 1.5 trailing stop level above me. And so I entered at the end of the day. Where is my end of day stop on this trade? It's exactly halfway, right about here. So my stop on this trade is very, very close 86.10, we're at 86.74. Therefore, next week, by the end of the week, if it closes below this orange line of 86.10, I will simply be out. Of course, it hits my emergency stop, I'll be out. If it moves up, I'll continue to take partial profits until I get to trailing stop mode. Then I'll go into trailing stop mode. So this trade is up a teeny weeny bit, basically break even. But yeah, it's up 0.31%. And then last but not least, on the weekly bars is XLF. I have been in this trade for a long time, which means it's been a positive trade. I got in all the way back March 24th of this year. I got in at 30.71 with rejection of the 250-day moving average. My end-of-day stop would simply be a close below the 250 week moving average. Excuse me. I have my 2 ATR stop below. I put my 1.5 trailing stop level up here, and you can see, so I bought here at 30.71. Next week moved up nicely, took profits. Had another week, moved up, took profits, got to trailing stop level, have another week up, took more profits. Now that I'm in trailing stop mode, I'm just looking for a close below a previous bar's low. Didn't happen. Moved up, took profits. Then here on the 23rd of June, first close below previous bar's low. I locked in a gain of 6.4%. Then we had a month, 5 weeks of moving up where I continued to take profits, continued to take profits, continued to take profits. Now remember, this is the kind of trade where I'm giving it a lot of breathing room because I've taken multiple profit targets off to the upside. I reduced my position by half on the close below the previous bar's low. So I'm just hanging in there and waiting for either a close below the 250-week moving average. If it moves up, I'll continue to take profits. If we get to the 65 RSI level, then the 5 EMA will come into play. If we reject the 70 RSI, I'll get out of half. If we have a close below previous bar's low after rejecting the 70 RSI, I will get out of the remaining position. So it's a good place to be when you're in a nice, good up position and you've already gotten out of part of your position because of trailing stop mode, because of taking partial profits. Currently, the remaining shares that I have left on XLF up 7.42%. So that is what we have for this week. Let's talk a little bit about trading psychology, everyone. This is from Peter Robbins. You can follow him at PR Robbins over on Twitter or over on X. Market Wizard, he was featured in Market Wizard's great trader. Whenever Peter says something, you should probably listen. It's probably good information. Let's see what he has to say today. To become a successful trader, you must believe you can become a successful trader. Don't let the setbacks change that opinion and allow the gains to reinforce that belief. So let's break this down. To become a successful trader, you must believe you can become a successful trader. Same with baseball, same with guitar. You have to believe it. If you can believe it, you can achieve it, right? You've heard that, but the mindset is important that you have to be able to believe in yourself. Of course, you're going to have setbacks, but that doesn't mean that you're done. Everyone's going to have setbacks. Michael Jordan has setbacks, right? Some of the best athletes in the world have setbacks, but they learn from those setbacks and they go forward and they learn from their mistakes. And if they're good, they try not to repeat them in the future. So first thing, to be a successful trader, you must believe you can be a successful trader. You know, I have students that at times go through drawdowns like we all do. And I tell them, look, you have to believe you're going to be a successful trader. If you follow the process, if you do what you're supposed to do based upon good trading principles, things are going to turn around. And they always do. But you have to believe. Don't let the setbacks change that opinion. We're all going to have setbacks. You just have to realize that we are going to have setbacks. It doesn't mean you're a bad trader. It just means at the moment you're out of phase with the market and you will get back in phase, but you just can't blow things up in the meantime. That's why you have to be patient and follow your rules. So don't let the setbacks change that opinion and allow the gains to reinforce that. Positive reinforcement is possible. You know, if you've been in a drawdown, you've been losing for a couple weeks or 3 weeks, yeah, of course, it messes with you. You're like, oh man, do I know how to trade anymore? It's just normal part of trading. But when you do start to have gains again, you know how all of a sudden you start feeling better. You feel better about yourself. You feel better about your trading because it's reinforcing that belief. So, but believe that you can become a good trader. If you use proper trading principles and a good process and you stick to them like a machine, you will become a successful trader. But you have to believe in yourself. When you have setbacks, when you have challenges, they're normal. Don't let that get you down. It's just part of the process. Go back to believing that you are a successful trader. And then when you do have gains, it helps to reinforce that belief. So thank you, Peter Robbins. I think that was a great post. And please follow Peter Robbins for some good information at PR Robbins over on Twitter. All right. So as I mentioned, we're going to go through the daily and the weekly trades that I'm looking for next week. Let's start off with Home Depot. Home Depot is in an interesting area. It's kind of playing between the black line, the 200, and the orange line, the 300, and we have the 250 right here in the middle. On the positive side here, Home Depot had this huge sell-off, lots of distribution in this stock. But now we are starting to consolidate and move sideways, which really just means you have an equal amount of buyers and sellers. That's what's causing you to go sideways. Sideways motion will eventually lead to a trend up or a trend down. That I know for sure. The direction, I don't know for sure. So that's why we need to key off of our levels. Right now we're at a 28.38. You can see on Friday we did reject the 200 and we rejected the 300, excuse me, and then a couple days before we also rejected. So it is starting to respect that 200. I decided not to take the trade because we were under 30 RSI. I'll take trades under 30 RSI with the rejection of a major moving average if you have a V1 involved. So what I'm looking for next week on this, a couple things. Close above the 200-day moving average, that would be a potential. A gap down, another rejection of the 300-day moving average with the V1 or a V2. That is also what I'm looking for. So it either needs to go lower, test that 300 again, give me a better risk to reward ratio, or move higher and close strongly above that 200-day moving average so that I have the support of the 200. Let's look at the weekly time frame. I like the weekly time frame. This is looking at the higher time frames. We're inside the value zone, the two greens. There should be some support at the -1 ATR channel. Doesn't mean we have to have it, but very likely that is a level. So I do kind of like Home Depot here based upon the weekly and the daily, but ideally I'd like to see this gap down on Monday, reverse back up, giving me a V1. And another rejection of the 300. That would probably show us that the low is in temporarily on Home Depot, or if it can move up above the 200-day moving and the -3rd ATR channel, that would also be something that I'm interested in. Netflix. Okay, well, you can probably already tell what I'm looking for on Netflix. We did go under 30 over 30, but what I'm keying off of here is the 200-day moving average. This is the black line. If we bounce at the 200 or go below it during the day and close back above, or alternatively close below it and then close back above it, then I would consider taking that trade. Here's the 200-day on the daily. Let's see how that lines up on the weekly. Well, right now on the weekly, we've rejected the 50 EMA. So that is a good location. So that's a level on the higher time frame that's acting as support. Remember, I want to see levels on both time frames being rejected. Well, right now, it rejected off the 50 EMA. So I like that. But as far as the daily, where I'm placing my trade, really about the only thing right now that I'm looking at is a rejection of the 200-day moving average. The SPY. I'm already in this trade because of the under 30 over 30. But if this fails, then the next stop to the downside to give a very good strong level where a lot of professional traders and large institutions would come in would be the 200-day moving average. So again, I'm already in this trade with an under 30 over 30, but if that fails and rejects the 200-day below me, then that would be another potential entry place for me. Bonds, TLT. Okay, I just mentioned that I will take a trade under the 30 RSI if certain things happen. Look, we're at 29.22. Next week, if we move up, yes, we could certainly move above the 30 RSI, but I don't think I would take that trade, everyone, because look how low it went. I mean, we were in the 23 24s, 25 RSIs. So if it moves back up to the 30 RSI, I think it's a little chasey. So what I'm looking for next week is um, Wednesday and Thursday. You see the V1, bar 1, bar 2 goes below bar 1's low, closes above bar 1's close. That's a V1. I didn't buy that because it was under 30, but now this halfway of this V1 bar here where I drew the line, this should act as support. I feel like it's a little chasey up here. Who knows? I could be wrong. Maybe it just goes straight up. But what it did close below its open, so I do think that it's potential, a very good potential that we could come back and test halfway of this bar, and so that's what I'll be looking for. Verizon, well, Verizon has really come back down, it got near the negative third ATR channel and bounced. It's 34.27. What I'm looking for next week on Verizon is simply a rejection of the 30 RSI. It bounces the 30 RSI, an under 30 over the 30 RSI, or a potential close under, close over the 30 RSI. Let's look at the weekly. Weekly, here we have the big up bar. We should have some support at the halfway. It's right about right about there. That's a key level. Right now we are underneath it. But ideally what I would like to see is I would like to see this go under 30 and reverse back up strongly for an under 30, over 30, which would also get us back over this halfway. We have a dividend coming up, 66 cents, by the way. That's a lot. So Verizon looking for a rejection of the 30 RSI next week. XLV looking for a higher low rejection of the 30 RSI. On Wednesday, we did go below the 30 and then closed back above it. That was a valid trade. I did not take it because it came from a lower low. Then we moved up a little bit and then we were down again on Friday. If we could go back under the 30 RSI and then back over the 30 RSI, that would be most likely would be a higher under 30 over 30 RSI than the one that we had on the 27th. So real quick recap, Home Depot, ideally what I'm looking for is a move down below the 300-day moving average, close back up with a V1, or alternatively, if it moves up, a close over the 200. Netflix, very simple, looking for a rejection of the 200-day moving average. SPY, already in this trade, but if it does fail, the 200 would be a very, very good place risk to reward ratio, especially on the index like the SPY. TLT, looking for a pullback of and rejection of halfway of Thursday's halfway of the V1. Verizon, looking for an under 30, over 30. And healthcare, also looking for another under 30, over 30. Now, I mention this each week, but it is very possible that we have 6 symbols here. It's possible that we could have all of these triggering at the same time. Does that mean I would take all 6? No. I only take one trade per day, whatever is the best one. What's the best one? The best one means how many confluences or confluences of and triggers of signals happened. Maybe Home Depot has 1. Maybe Netflix has 2. Maybe S&P has 3. I'm going to take the one that has the most. The most confluences, the best risk to reward ratios, the best relative strength of what that particular market based upon the broader market, how that is reacting to that. For example, if the market was all down and red, but one of them was up, that would be relative strength. And then what looks best on the larger time frame. So again, these are all things that I teach in my one-on-one. It's really important to give a score to each one of your trades that potentially trigger. They could all trigger in the same day, but I'm going to narrow it down to the best one, the one that gives me the best chance, right? The more signals you have, the higher the probability that that is going to be a successful trade. Let's look at the weeklies now. Apple, really nice potential for a return to value V2. We were above the value zone. Here's the value zone, green line, green line. We came into the value zone. We have moved sideways. Last week, we moved to the downside, but if we could close back above 174.70, then we would have a V1, bar 1. Last week was bar 2 that washed out bar 1. If we can close back above bar 1's close here, which is about 174.70, it would be a return to value, sideways motion, washout bar, V2 entry, and on a stock like Apple, that would be great. So that's what I'm looking for. Let's see the close there, 174.79, 174.79. So next week, if Apple closes above 174.79, very likely I will take the trade with the reverse return to value, sideways motion, V2 entry. Gold. Wow. Well, what what jumps out to you on gold? 200-day moving average down here. 200-day moving average dovetails with the negative third ATR channel. 92% of prices fail, stop going down or go back up when we get to the negative third ATR channel. You see how the black line and the negative third ATR channel are dovetailing here? Confluences, again, more confluences of support. So next week on Friday, because this is a weekly trade, if we go below the 200, close back above, or bounce at the 200, I will potentially get into gold to the long side. Silver, it's going to be very similar. Here on silver, you can see the purple line. Look, last time we rejected this purple line and closed back above, look what happened. Straight up. So again, I'm going to look at see if we get a rejection of this 250-week moving average. Whenever I look, for example, here where I'm looking for a rejection of the 250, I always look back in time and say, did it hold last time? It did. Doesn't mean it's going to hold this time, but it gives it better odds. So I'm looking for some kind of rejection next week of the 250-week moving average, which is at about 1970, so about 60 cents lower. Verizon, well, talked about Verizon on the daily, also looking for potential higher low V2. Higher lows mean we close below the value zone, green line is the value zone, we rally into the value zone, we pull back, and then create a V1 or a V2. Well, everything is set for a potential higher low V2. If we close above 33.28, it will be the V2. Bar 1, bar 2 goes below bar 1's low, bar 3 closes above bar 1's close. This low would be higher than this low, therefore a higher low V2. So that's what I'm looking for on Verizon. And then XLF. Now, I am in XLF all the way back here from the 250, if you remember. But the 200-day moving average here would also be a very good level. You can see last time it respected the 200 and moved up off of it. Therefore, if we get back to the 200-day moving average, I will probably create a new trade. I'm in from the 250 way back here, but of course I've been scaling out and trailing stops and all that kind of stuff. So I don't have a lot of shares left. So if we go back next week and reject this 200-week moving average, then that would be a place that I would be looking for to just morph it into a new trade. So just real quick recap. Oh, and by the way, always forget to mention this, but if you like today's podcast, if it's been valuable to you, if you find any value from it, I would really appreciate it if you could just hit the thumbs up button. It helps out the channel immensely and lets YouTube know there's some valuable content here that people liked by hitting the thumbs up button. It's really quick. It's totally free. So if you wouldn't mind doing that, I would appreciate it. So real quick recap on the weekly. Return to value potential V2 next week only on Apple if it closes above 174.79. GLD looking for some kind of rejection of the 200-week moving average. Silver looking for a rejection of the 250-week moving average. Verizon next week and next week only, a close back above 33.28 would give me a higher low V2. And then again on XLF, rejection of the 200-day moving average would be a great entry point. So, at the beginning of the course or the beginning of the podcast, I talked about my one-on-one stock trading lessons. Listen, if you want to study with someone that's been trading a long time, has a lot of experience, has really good strategies, I think I'm your guy. Like I said, I've taught people from all over the world. I teach a great course. I'm very patient. I'll teach you step by step. So if you're interested, my email is the link in the description. All you have to do is send me an email, and we'll start things. We'll start a discussion. You can ask as many questions as you have about the format, the syllabus of the course. But I've taught so many people, so many good reviews, so much good feedback. So if you're interested in learning the trade, the skill of trading, just send me an email and we'll get it started. If you like online courses, I have a really good, affordable course online where I teach you the deep dip buy stock trading strategy. It's on udemy.com. The link is in the description. I've sold so many of these courses all over the world. I believe there are 26 videos, 9.5 hours of video, 15 study guides, and it is a great course and it's very affordable. It's only between $12 and $15 on Udemy. And if of course the one-on-one training is of course better because you learn all 5 different trading approaches and you have me at your disposal. But if financially you're not able to do that, starting off with this Udemy course is a great place to start. So consider that. Links in the description. And I always like to leave off with this. If you could go out and do something nice for another human being today, it would just make the world a better place. And I think this world right now, we could definitely use people doing nice things for nice people so that we're so not divided. And if you could also go out and do something nice for an animal today, that would be great. I was raised with a lot of animals. They were my friends and my playmates growing up, and I can promise you they appreciate acts of kindness as well. So if you could just try to go out, do one nice thing for another human being today, if you could try to go out and do one nice thing for an animal today, it'll be good for that animal or that person, and also you'll get a lot of rewards for it as well, and it would just make the world a better place. And what's wrong with that, right? So anyway, yes, quite an interesting week in the market. We will see what happens next week. We're in a period of volatility, and as always, be careful. Be patient, wait for your signals to line up, act on your signal, be patient with your winners. When you have winners, be very impatient with your losers, and God willing, I will be here next weekend and we will see what happens next week. Should be an interesting one. So thank you so much, everyone. Appreciate you being here. Have a great rest of your weekend and talk to you later. Bye-bye.
U.S. government required disclaimer. Stock options future appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.